lower taxes in retirement. Unfortunately, that's a lie for most. And Aaron, I know for those of us that are coming back to Elements in Focus, this is a new bit of a new format. So welcome, folks.
Mhm.
Glad to have you with us. And yeah, I know this is quite a loaded statement, but Aaron and I and the rest of the team have been beating this drum from the top of the mountain for a long time. Lower taxes in retirement is not necessarily what takes place for the vast majority of us. Tax deferral for a long period of time was tasty, right? We call that eating cake instead of broccoli your entire life, right? Having a balanced nutritional diet from a tax perspective, only to get to retirement and then realize that, oh no, I'm now in the same, if not higher tax bracket than I was before. And Aaron, I think you have a really good story that articulates that, or at least an example.
Yeah, Grant. As you mentioned, for most people, most families that we're taking care of, a lot of their retirement journey, they didn't have the Roth option to be able to save in. So that started in 1997. And at the time, you could put $2,000 a year into a Roth IRA, and it was income limited. So hardly anybody started to put money into the Roth. And so for most working careers, as you mentioned, money was being tax deferred. And the genesis of that is so that when you do retire, you'll be in a lower tax situation. However, as Grant mentioned, for a lot of our families, that is not the case. Think about mailbox checks, the checks that you receive on a monthly basis. A lot of the families we take care of have pensions, they have Social Security, maybe there's rental income. Those are checks that are going to hit your tax return, whether you want that money or not. And for a lot of folks, those dollars ratchet them up that marginal tax bracket. And because of the way that you save tax deferred, at some point, the IRS is going to say, hey, it's time for us to get a slice of the pie that you've not paid any taxes on for your entire working career. And those happen in the form of required minimum distributions. Today, those start at 73. In about 8 or 9 years, they'll go to 75. And the account balances are not getting smaller over time. The market continues to go up, and that means just more money that you'll have to pull out of an account. And so, for a lot of people, when you factor in Social Security, pension income, and those future required minimum distributions, folks are in a same tax bracket they were working, or even in a higher tax bracket. And the icing on the cake is if you have a spouse that passes away, some of those income sources don't stop. If you have a pension with a survivor benefit, that will continue. Higher of the two Social Security stays intact, and those feisty, nasty required minimum distributions do not stop. So if we work together and partner together, we want to focus on proper tax planning to make sure that we can help you through that lie that lower taxes in retirement. Grant, I'll swing that back.
Absolutely. Yeah, and Aaron, absolutely, you're right. Sorry to cut you off there. I'm just, this topic really gets me jarred up. Um,
Mhm.
because yes, the other element to that, Aaron, as well, is the tax code is now fluid,
Yeah.
right? I mean, we're going to have a sunset in 2026. Taxes are going back up. And I don't think there's a lot of Americans that truly believe that after the sunset, if it does go back to where it was prior to 2017, that we're not going to have higher taxes even probably a decade from now, right?
Sure.
We have a debt issue that is fixed by income, taxes generate income. So I think we're just kind of in this snowball of, a tax tsunami for many individuals and families going forward. But Aaron, you said it, there's good news for those that are watching, like, oh my gosh, well, if I'm in this exact same position Aaron stated, what can I do? Proper tax planning. Not to make anyone jealous or even well, I guess jealous is the right term. When you do proper tax planning, you partner with the right team, as Aaron stated, you can have the tax freedom that some of our families have. For example, I serve a family that's kind of in the surrounding community where now they have a 0% federal income tax because of the tax planning we were able to do over the last 5 years. And
Hmm.
so they're going to be primed to have a tax adjustment after the tax code sunsets. and they'll be walking away scot-free. And while Uncle Sam's coming to all of our pockets, they're going to walk right by and wave at him. So if you're in the position that Aaron stated, please don't be afraid. Don't get down on yourself. There's still time to plan, and there's a great team that's you're watching here that can partner with you to do so. And if that's something you want to evaluate, if you're looking to understand where you're at in your tax position, if you're looking to adjust where you're at in your tax future, give us a call, 800-928-4001. If you have questions about your tax situation, shoot us an email, talk2feg.com. I'm sorry, talk2feg at yourlifeafterwork.com. We'd love to connect with you. But thanks for the time today. Look forward to talking to you soon. We'll see you at the next one.
Hi, I'm Sam Neff, certified financial planner with the Financial Enhancement Group. If you're interested where you stand personally, please click the link below and you can create a profile, and a member of our team will reach out to talk about where you stand within the 5 critical elements on your financial journey. Thank you for your time, and we look forward to speaking to you soon.